was after 2012, I knew everything was fucked and the financial system was in real trouble. And the only answer now was printing more money, which was devaluing the value of money itself. And that the debt burden couldn't go away now. You couldn't press the reset button because it's too catastrophic. We almost got there in 2008. And then had it happened in 2020 with the pandemic, it would have been the end of everything because the debts had just got bigger and bigger and bigger. This debt super cycle we've been seeing over the time. So I realized back in 2012, having almost lost the whole system in Europe, I thought we need a way out. So one of this was educating people. I wanted to tell people how to think about this really complicated world we live in where we've gone too far, where debt has gone too far and we risk losing everything. So we go back to 1997. There was 150 million users of the internet, and that network of people was growing at 63% a year. The world had never seen anything adopted this fast. Wind forward to today. There's 150 million users of cryptocurrencies. That network is growing at 113% a year. It's twice the speed of the internet. We have never had a technological adoption like this in all human history. So what does this mean? What does this mean for people, right? What it means is networks are valued in a different way to other things. They're valued by what's known as Metcalfe's law. Metcalfe's law states the value of a network is basically the number of people on the network, users, in this case cryptocurrency owners, and then the number of interconnections, applications and other stuff. So if you think about my phone, right, when we first got a mobile phone, I could call you. Now it's a computer, right? The number of applications and everything else. So the value of all those mobile phone networks added together, plus Apple and everything else, is like mind-blowingly big. The value of crypto is really interesting because this is a network of money. We've seen these network models before, like Facebook. So Facebook is a big network. It's valued according to Metcalfe's law. But the difference with Facebook is we as users only get the benefit of the likes and the comments and connecting with our friends and family, or using it for business, and Facebook shareholders made all the money. When you create a network of money, the more people come onto the network, everybody who comes onto the network owns a token. And the value of the token goes up the more people go into the network. So it's like ultra powerful. It's like behavioral economics 101 is give humans a network of money, they're going to make it go up in value and they're going to adopt it very fast. So that means in layman's terms, this is a $2 trillion asset class as of today. All the other asset classes, equities, bonds, real estate, gold, all of these things are bigger. Gold is about 8 or 10 trillion. But equities, global bonds, global real estate, they're all between 150 and 350 trillion dollars. So if this is truly the asset class we think it is, and its adoption is growing as fast as this, the maths, just the simple adoption maths, suggest that it gets to 200 trillion by the end of the decade. That's 100x. So if you think you're in the Middle East, if you think the wealth that happened in the Middle East from after the kind of Brits moved out and the ruling families took over and discovered oil, that amount of wealth came fast, but it actually took a while. So there was like 20 or 30 years from the 50s to the 70s. And then that amount of wealth was huge. Same with Russia. What happened in Russia once they opened up. What we're doing here is going to create something much larger, totally global in scale, that allows people to make enormous amounts of money as we completely change the world's financial system and the world's business models. And this is the opportunity that we've been given to us. This is the opportunity that we all have to tell other people about, because I don't want anybody to come back to me this time around and say, why didn't we know? This is the opportunity. And what's really unique about it, you can be a construction worker from India living in Dubai and put in a few dirham a month, or you can be a rich dude and put in whatever, but you can both put in 5% of your earnings every month. And it stops the rich poor divide, because this stuff gets fractionalized. So Bitcoin, oh my God, it's $66,000. No, you can buy a small fraction. So everybody can buy the right percentage for them. How I did it very simply, and I suggest everybody does it, is don't go diving off the end of some token that somebody randomly told you about in a bar. Go about it intelligently and say, okay, the two big exposures here are Bitcoin and Ethereum. Let me just weight my portfolio by their market cap weighting. So Bitcoin's just over $1 trillion and Ethereum's $450 million. So there's a weighting for you. This kind of market cap weighting, like you would be if you bought the S&P 500. So that's a pretty easy place to start. Then put it in your portfolio and get to understand the volatility, what it feels like to own this, because you haven't had an asset class like this before that's so volatile. So you're going to have to learn to fight your own psyche, which is panicking when it goes down, getting euphoric when it goes up. You have to realize it's a long-term investment because we're talking about something that's going from 2 trillion to 200 trillion over 10 years that you need to not think about, much like stuff in your retirement account you don't think about, and let it grow. Now, what's going to happen is magic, and it's happened to all of us, is once we do that, we start reading the news about it. Why did it go down? Why is it going up? What's going on here? Oh, that's interesting. Oh, but what does this new token do? Oh, that's interesting because that's a bit different to this one. And before you know it, you learn by osmosis. It becomes easy. But if you start with Bitcoin and Ethereum to say, let me just use the simple frame of reference, which will be wrong over time, but Bitcoin is the store of value. It's kind of gold with a call option on the future. And Ethereum is the platform for all of the applications to develop. So if I think of those two things, I'm kind of covering the entire space for the initial thing because so much is built on Ethereum. Once you've got that, you'll open your mind and then you're comfortable with, okay, I've got the base layer. Now, what do I want to do from there? So let's say you got a good job, you got a place, you got a mortgage, you got a car, everything's fine, right? You're just in the grind. That's most people. So then you've got to think, okay, what investments do I have? Do I have investments? What is my strategy for the future? Now, what you'll probably find is kind of if you're over the age of 40, you've built up some kind of investments, you've probably got some equities and you've got some bits and pieces, you might have some gold or whatever it is, right? So you look at that and think, okay, what is my future expected return? Well, most of those things kind of go up about 6% a year. So you realize that and inflation is running pretty hot. Central banks are kind of debasing by about 15% a year. You're kind of thinking, okay, fine. I'm kind of standing still, but I'm not going to make a fortune. Can you be a genius stock picker and make more money because you time the tech stocks right? Sure. But it's not easy. So then you think, okay, if I've got my portfolio in that stuff, if I were to add crypto into it, let's say 10%, then let's say Raoul's a total idiot and Spence has completely got it wrong and this goes to zero. You lose 10% of your net worth while you are still making money in the other things you've got investments in and you've still got your earnings. Frankly, you don't care. But if I'm right and it goes up 100x, you've gone from 10% to 200%. You've doubled your entire savings. So that's just from a small investment. But really it gets interesting when you're younger, and the Middle East is full of young. If you're younger, your ability to take risks should be higher. So I don't think the day of reckoning is coming. I think it's a slow day of reckoning, where over time they devalue the currency and we just get poorer. So how do you get poorer in this situation? Well, traditionally an asset is what we put our money into to defer future consumption. So I buy stocks now so I can, when I'm retired, sell them and spend it on wherever I want to spend it on, right? That's what an asset is. You can pass it on generations. That's all we use assets for, deferred consumption and to protect the value of that investment. So if your income is not going up much, and it's not generally, but the price of these assets is going through the roof because these are valued in US dollars and the US dollar or all of these currencies are being printed. So it's actually falling. So it makes them look like they're going up a lot, but they're not. So what you've got now is your same income and all these assets up here. So your future self is now poorer, a lot poorer, because you're putting in the same amount of money every month into these assets, you're buying less and less of them. This is the trick, is you're basically devaluing your savings and your earnings and your what you earn and what you can do with that earnings. And so this is why crypto solves a lot of these issues.